So let's talk about PhonePe. You probably use it all the time, right? But here's a question that might have crossed your mind. With this company being so massive, can it actually ever make a real sustainable profit? That's what we're digging into today. Just to give you a sense of the scale we're dealing with, look at this number, 185 billion. That's how many UPI transactions happened in India last financial year. It's just mind-boggling growth, and PhonePe is sitting right in the middle of it, basically dominating this entire ecosystem.
And that right there leads us to the big paradox. We all know UPI is free. You use it, I use it, it costs us nothing. So how in the world does a business that's built its entire foundation on a free service ever plan to make any money? That's the puzzle we're gonna solve.
All right, so here's how we're going to break it all down. First, we'll tackle that scale paradox. Then, we'll deconstruct their business model using a pretty neat analogy. After that, we'll get into the profit puzzle, look at the big challenges they're facing, and finally, I'll give you a simple framework you can use to think about their future. Okay, section 1, the scale paradox. Look, it's pretty clear PhonePe has scale. That's not even a question. The real head-scratcher is how you take that gigantic user base, which is used to getting the core service for free, and turn it into a business that actually makes money year after year. Now, PhonePe does a whole bunch of different things, and honestly, it can get confusing really fast. So to make sense of it all without getting lost, we need a simple way to think about their strategy. We need a good mental model. And you know what? We don't even have to invent one. PhonePe itself actually talks about its business as a three-layer cake. And this is really the key to understanding how they see their own company, from the very bottom layer all the way up to their biggest bets on the future. Okay, so let's slice into this cake. Layer 1, that's the base, is daily payments. This is all about building habits, right? Getting you to use the app every day for UPI for bills. Then, layer 2 is the monetization layer. This is where they actually start making money by selling tools to merchants or offering financial products. And the top layer, that's for new platforms. Think of these as their long-term moonshots, like their very own app store, all built on the success of the first two layers. Now, this is where it gets really interesting. When you look at how this cake model actually translates to real money, you see that a whopping 63% of their revenue comes from that foundational consumer payments layer. Merchant payments are a decent chunk, financial services are small, and those new platforms are barely even a sliver right now. But hold on, how is that biggest piece so huge if UPI is free? Well, here's the secret. That consumer payments bucket isn't just about you sending 100 rupees to your friend. It's also where they collect commissions on stuff like mobile recharges and bill payments. Sometimes they'll tack on a small convenience fee. And on top of that, they actually get incentives from the government for processing all those small digital transactions. So that's how the free layer actually brings in the cash. Okay, so now we get the revenue part, but that brings us to our next big question, the profit puzzle. Because when you look at PhonePe's financial statements, profitability is kind of like a magic trick. Now you see it, now you don't. And this slide just lays it out perfectly. If you look at one number, their operating profit, or EBTI, you'd think, hey, things are looking pretty good. But then you look at the final, actual bottom line, the profit after tax, and boom, they're showing a loss. So what on earth is happening between those two numbers? The first big piece of the puzzle is a little accounting term called depreciation. All this means is the cost of a big physical thing they own, like a massive data center, sort of wearing out over time. Now, it's not cash going out the door today, but it's a very, very real cost that reflects how much they've invested in their own gear. And this quote from our source material just nails it. You think of PhonePe as a software company, right? But weirdly, they own a ton of expensive physical stuff. Most of their competitors just rent server space from companies like Amazon. PhonePe made a very different choice. And here's the trade-off they decided to make. By owning all their own infrastructure, they had to spend a huge amount of money up front, which leads to all that depreciation we just talked about. But the bet they're making is that in the long run, because they're so huge, this will be way cheaper than renting, where your bill just goes up and up and up the bigger you get. But depreciation is only half the reason for that profit puzzle. The other massive factor is something called share-based compensation, or SBC. This is basically when you pay your employees with stock in the company instead of cash. And while it doesn't burn through your cash reserves today, it is a very real cost because it means everyone else's slice of the company pie gets a little bit smaller.
So, how big of a deal is this SBC stuff? Well, check out this number. If PhonePe didn't have to account for these stock-based payments, it would have posted a profit of 630 crore rupees last year. Instead, because of that cost, it posted a loss. It's pretty much the single biggest thing flipping their bottom line from black to red.
So it seems like PhonePe is kind of figuring out this whole profitability engine. But just when things are starting to click, the world outside is changing. The rules of the game are shifting right under their feet, creating some pretty serious new roadblocks. And here are the three big ones. First, regulators have basically flipped a kill switch on a couple of their high-margin businesses, like charging fees for paying rent with a credit card and for real money gaming. Second, those government incentives we talked about, they're getting smaller. And third, there's this big 30% market share cap for UPI that's always looming, which could literally stop their main growth engine in its tracks.
Wow. So, with all that complexity, how are we supposed to think about PhonePe's future? Well, that brings us to our last section, a simple framework you can use to watch them and judge their progress from here on out. Here are the three key things to keep your eye on. First, watch their revenue. Do they start making less money from those fragile consumer fees that a regulator can turn off overnight and more from sticky, durable merchant services? Second, can they actually grow their financial services business, selling things like insurance and loans? And finally, can any of those new platforms that are just burning cash today turn into real profitable businesses?
Which really leaves us with this final question. PhonePe has built something truly massive, something impressive. But is it a fortress built on a solid ground of a sustainable business model? Or is it a beautiful three-layer cake that's just sitting on a very shaky table? At the end of the day, only time will tell.